Hi, Gary.
What's up, Anita?
How are you?
Good. How are you?
I'm good, thank you. Thank you for doing this with me. How is it going over there?
I'm busy.
That is an awesome thing.
Yeah, not bad. Got maybe six or so closing in the next week, hopefully.
Six? You are a beast.
Sorry, my signal's terrible. I'm in a bad.
That's fine.
How are you doing?
I'm good. Your picture was really nice. How are the boys?
They're pretty good. The youngest one's birthday is on Friday, so I'm gonna try to see if I can skate out of here and go hang out with him for his birthday.
That's good.
Hello.
Hi, Mr. Gupta.
Yes, hi, Anita. How are you?
I don't see you on camera.
Let me see how this thing is done. It should be. It asked me for.
You're joined by video.
Right. Yeah, I did that. Um, Share screen. I did that. Chat. Stop video. No.
Hi, Aaron. I can't hear you. Aaron, you are mute.
I wonder why I'm. Here you go.
Aaron, I can't hear you. Mr. Gupta, I can't see you.
Yep. Here you go. Now
Aaron,
you
I can't hear you.
you can. Can you see me? No.
Yeah, I can see you.
Yeah. All right.
You can't hear me?
I can hear you now.
Okay, I was just checking.
All right, thank you guys. So, Gary, Gupta, Aaron, meet each other. You are all loan officers. Thank you.
All right, guys.
Hey,
Hi.
how's
How are
everybody
you?
doing? I know
All
everybody's
right.
rolling, man. Hope you guys are rolling.
I
We're
know.
rolling. I'm trying to keep up.
Good part is we are busy, so that's good.
Yes, sir.
Absolutely.
Mr. Gupta, I can see you. You need to bring your camera in a bit. You are very far away.
Don't know how else I can.
Okay, so I have some questions prepared. You can jump in anytime. At some point, I know some of you have specialties. Aaron, I know you do 203K and VHDA. So at some point, I'll ask you to emphasize on that program.
Okay.
Gary, I know you have the 0% down payment grant. So at some point, I'll ask you to emphasize on that. All of you do FHA and VAs. But I will ask Mr. Gupta to emphasize on FHA because he just does general.
Okay.
Okay. You are
Hey,
very
Mr.
dark.
I was gonna say, Mr. Gupta, is there any way you got any light that you can put in your room?
That's what I'm trying to figure out. What did I do here? Why
He's
am
that
not?
shadow. He's like the
Yeah, I was
drug
gonna,
lord
they're gonna
on.
be like, they were like, he had good information, but I wish I could see what he looked like.
Here you go.
You
No,
were there before.
No,
still
no,
not.
like when you stood up, it was better. Like
It's
when
the
you
Yeah.
stood
back. It's the
weird.
windows. It's the backlighting of the
The
windows.
background window,
Right.
maybe I move
Yeah.
it to.
Yeah,
There you
move
go.
over there.
It's all that natural light coming in.
Yeah.
Hey, here you go.
Hey, there
Yeah,
you go.
are
Yep,
much
there you
better
go. There you
now.
go. Yep.
Okay, so I'm gonna connect it to Facebook Live as soon as he's situated.
Anyhow, we'll figure it out. Okay, go ahead, please. That's not.
Okay, much better. Okay, so let's go. Give me 1 second. Are you all ready?
Yes, ma'am.
Yep, let's start.
Okay, give me 1 second while I log into Facebook.
I want to thank Anita for actually making me put on real clothes as opposed to a t-shirt and sweatpants every day.
Ah, yeah.
I got a couple loan officers. We do these Zoom calls every morning. So I got a couple loan
You're
officers
live.
here. And that's that story.
Oh, there you go.
Right. So
So
Anyway, so they get dressed up in like button downs, like tops to look good for the camera.
And then they got
Right.
sweatpants on.
Yeah,
Guys
sweatpants
are
and shoes
live.
on the bottom.
Hello.
one moment.
Should I do some cartwheels or something?
what's the
If I log into Facebook, will I be able to see what's going on?
Yes.
Oh, snap.
Yeah, I'm already in, so that's why I was looking for the link. Yeah.
Okay, let's go.
Cool.
Let's go to Facebook. Let's see what's going on in Facebook
Yeah,
land.
I was there too. Yeah.
Okay, welcome to my third edition, which is Dynamic Personalities, where I feature, welcome to my third edition with Dynamic Personalities, where I feature people in the community doing awesome things. Today we have with us some great loan officers in the community. They are serving people. They are making sure people are getting into the right homes with a good financing program and refinancing folks' current loans for them. So I want to welcome Gary Miller, Abdul Gupta, and Aaron Simmons. Can you introduce which companies you all work for? Gary.
Sure. I am currently with American Financial Network out here in Woodbridge. I've been here for about 4 years we have, and been doing it before that about 10 years with NVR Mortgage and Ryan Holmes. So a total of about 14, 15 years in the industry.
Wow, thank you so much. Aaron.
Sure. Aaron Simmons, First Heritage Mortgage, out of the Fredericksburg area. Prior to that, I was with George Mason for a 3-year period of time. I've been with First Heritage going on 4 years. And then prior to that, I was with Prosperity Mortgage for 9 years. So about 15 years experience total. And thank you for the opportunity to speak to your great client base as well. This is awesome. I'm glad to see other professionals here as well.
Thank you so much. Mr. Gupta.
my name is Atul Gupta, and I've been doing it since, I guess, 15, 16 years as a branch manager for a lot of different companies. Now I work for the DMV Home Funding. I have a very good team, very well experienced team who take care of our borrowers, all kind of loans. Yep, here we go.
Thank you, guys. So today we have 3 loan officers on the hot seat here to answer some burning questions concerning the mortgage industry. So let's go quickly and just dive into the questions. So can you guys explain to me what forbearance is? Because we are hearing that in the news and most people are thinking of applying for that. What is forbearance?
I was going to say all of us don't want to. Don't want to jump too quick to the gun.
Exactly. So let us know who wants to.
Yeah. Essentially, I'll start, and then I think that we can kind of all play off each other. What I will say is that forbearance does not mean do not pay your mortgage payment. That is number one. Typically, what happens is that it's a one-time, and for a lot of clients, they have to remember it's a one-time, a little bit of a relief. But typically, what a lot of servicers are going to start to probably do, and you guys can correct me, is either try to modify those loans or maybe even put in some form of deferment to possibly on the back end, or they might be calling that total amount due on the front end. So, for example, if you got a 3-month forbearance for, let's say, a May, June, and July, when that August payment comes around. Some servicers, and I know we just had a few guidelines from Fannie Mae and Freddie Mac that have stated, hey, we're not going to call that total amount due, but some servicers might require that full amount for that 3-month relief period of time that you were granted for a portion or all of that to be due. And Gary and Atul, you guys, don't let me talk all the way. You explain a little bit better. You got some more information for the people, because I don't.
Yeah. No, I mean, that's pretty much, I think, a good answer, or textbook answer as to what exactly it is. And I think really kind of the unfortunate part right now is that, the media, the government's really kind of only pushing, hey, here's this great way that you can potentially, make sure you don't fall into a situation where you go into foreclosure by just calling, asking forbearance, and even better, you don't even really have to provide any documentation to prove it. And so the dangerous part of that is that, a lot of, people who are not familiar with mortgages or just how exactly, what exactly that means is, a lot of people are maybe looking at it in terms of an opportunity to just be able to skip paying a mortgage, as opposed to what it was actually designed for, which is to really help people who are in need. And so the dangerous part, like Aaron said, was just the fact that, right now you don't have to make the payment, but what will happen is, chances are, as you fast forward the 3 months, the 6 months, the 9 months, up to 12 months, which is what, the government came out with in the beginning of April, is that, once those payments start again, you could be on the hook for every single payment that you missed up front. And so that's the part that you really kind of have to be careful and make sure you ask the appropriate questions of your servicer. Not necessarily of, your friend down the street who did it, the loan officer who even closed your loan, because more than likely the servicing transferred. You really need to make sure that those questions are asked of the actual institution, your servicer, the place you're making your payments to.
I don't know whether we answered this question now or later, that they will have a problem doing a refinance.
That was my next question. Can a borrower refinance after forbearance?
Once they are current on their mortgage, then they can do it. They cannot, they won't be able to do it while they are in the forbearance.
Right. Yep.
So and you don't know what the rates are going to be at that time. So like Gary was saying, it is for the people who really need help, not for everybody should not do it, rather because the rates are so low. They should rather do a refinance. And you get another, 1 or 2 months away from there also. If it is possible to do it, you can rather do that rather than stay away for 3 months and then you have to pay the whole amount and then you cannot do a refinance. You cannot take an advantage of that. So like I said, you need to talk to the loan officer or talk to somebody who really knows what your requirements are and whether it is good for you or not.
Okay, so
one additional, I'm sorry, Anita, but one additional thing, and Mr. Gupta, that was great content. The CFPB, Consumer Finance Protection Bureau, they have a great video. If you consumers go to their website, and it's got a long list of what is forbearance. This is what can happen. These are the potential dangers. And the reason why I'm mentioning that is that's not coming from Gary or Mr. Gupta or Anita. This is coming from the Consumer Finance Protection Bureau, that consumers need to be specifically aware of. These are some of the things that can happen. So, from a lending standpoint, all of us as lenders are trying to point, our consumers, go to your servicer. As Gary said, that's the #1 place, because they're going to be the ones that are going to be making the decisions on what you're going to be doing in the future anyway. Okay,
so to recap, what I'm hearing is individuals need to apply for this program if they truly, truly need it.
Correct.
And they may end up paying it at the back end of the loan, or they can be off on the hook at some point before the end of the loan. Is it what you guys are saying? Clarity.
Well, they have to pay no matter what.
Yeah, you're gonna have to pay. Yeah, and this is 100% my opinion. The unfortunate part is I think that it was good intention, but the people who are pushing out the information don't understand the industry at all, period. And so if you're in a situation where you can't make your payment, so you say, hey, because you lost your job or hours are cut back or whatever, and you turn around and say, I need a forbearance. Yeah, that's fantastic for this month. But if you don't have a job, where are you going to get the money to make the payments later? It's not like you're going to get this magical influx of cash. And so really, if you are in a dire situation, what you need to do is call and ultimately ask for a deferment where the payment is specifically tacked on to the back end. Because all a forbearance is going to do is stop the bleeding today. But it does you no good once your $2,000 mortgage payment times 3 plus that month comes due, once that forbearance period is over. Because chances are you're not landing a job in the meantime where you're going to get this huge sign-on bonus. Your company's more than likely not going to back pay you for lost wages. And so really, it's almost reminiscent of HARP when they said, hey, you're upside down, no problem. We'll go ahead and refinance you regardless. And then what happened is they said, oh, sorry, we can't help you because you're current on your mortgage. So then everybody stopped making mortgage payments. And then they called back, hey, I'm 2 months behind. Hey, sorry, we can't help you because now you're behind.
Right.
It's just like, well, that's what you told me to do. And none of those, it was years that people weren't able to refinance because, again, they got half the information and tried to either exploit it or just didn't ask the right questions. And to be honest, the industry and the decision makers just didn't understand all the cause and effects. Okay. And so, at the end of the day, if you are in a tough situation, it's all about asking questions, making sure you understand, and really not just trying to exploit an opportunity.
Awesome. So what I'm hearing is don't do it if you don't have to, and you could be on the hook once the 3-4 months forbearance period is over. Correct. And you may not be able to refinance once you apply for forbearance. The best way is to do deferment payment.
If you can, yep.
Yeah, and I would just say, I think taking out the words, if you are going to be on the hook, no, you are on the hook. Yeah. You signed a note that says you're required to make 360 payments or 180 or 240. You have to meet the terms of that note. So whether or not you're meeting the terms of that note after your forbearance or on the back end, you signed a promise to pay the mortgage company. So those payments are not going away. So the client needs to be thinking, I need to do my best to make my mortgage payments at all times.
Thank you so much. That is truly informative. Now, the follow-up question is, how will forbearance be reported on a credit report? From what I'm hearing, it looks like it's going to be bad.
As far as I think, they are not going to report it as a delayed or anything like that. Okay. It's not going to be, will not affect your credit.
So then how does it affect your refinance if it's not on the credit report?
It'd be on the mortgage statement. Oh, sorry, go ahead.
Yeah, go ahead. Yeah.
Yeah, I was just going to say, what's going to happen is part of a refinance, you have to supply your most recent mortgage statement. And when they see that mortgage statement where you have those past due payments, you're going to get a condition, you need to bring it current.
Yep.
Is during the process. And there's also a credit supplement that you have to order the month of closing to show that you've made the most recent month's payment. And if that's not the case, you have to bring it current. And then once it's all said and done, and if you're in a situation where that note comes due and you didn't make the payments, well, then guess what? More than likely at that point, it will be reported to the credit bureau. And now you're done for, potentially 12 to 24 months.
Got it. Okay, so another thing trending right now in the news is interest rate is at its lowest. People think interest rate is 0. And I tell people, no one is going to lend you money and have 0% interest on it. But you guys are the experts.
Look, we would like to. Shoot.
Can you guys clarify that? I mean, it's good, but you are the expert. Tell me what's going on with interest rate.
Interest rates, and I think we'll all touch on this. Interest rates right now, they are fantastic. They're extremely good. I think the one thing that, when the Fed had dropped the rates, the one thing, that was the main thing that consumers were coming out saying, oh my gosh, the rates are going to be good. Well, home equity lines of credit, fantastic. Credit cards, fantastic. But when it came to mortgage rates, all of us, we saw that great week that we had to where rates had dropped. And then the next week it was, what exactly is going on? What exactly is going on right now? Interest rates, they're really, really good. Obviously, everything is transactional, but if you're in the market to purchase or refinance or even do some cash out, I think all of us would tell people, you know, it's a fantastic time to look at those options to see how you guys can save money for yourselves and your family as well.
Okay.
The rate are not only governed by what Fed has done. It is a global market. A lot of other factors are governed by that. So yes, when they lower it down, it's going to affect some other commodities and everything else. But yes, the mortgage rates does not directly affected by the Feds. So
So is it zero for real?
No.
Okay.
No.
So that's a common misconception. So what the Fed doesn't set interest rates for consumers. The Fed sets the interbank rate. So basically the cost that banks lend to each other. Okay. So what happens is if because, you know, banks are required, and this might get too deep, I'll try to summarize it real quick and you guys to jump in, of course. If, you know, banks are required to keep a certain amount of money on reserve. In order to extend loans, they may have to, you know, borrow money from other banks so that, you know, they're in compliance as far as, you know, the different rules and regulations they have. So what happens is when Fed drops the rate to zero, they're basically saying, you know, if Bank of America wants to borrow money from PNC, there won't be an interest rate. You just basically pay back what you borrow, period. So what happens is usually you see a trickle-down effect. Well, if the banks can borrow money from each other at a lower rate, well, then that means that bank now has the ability to go a little bit lower. So then they're going to offer it to their consumer a little bit lower just so that they can get business. Well, then the next bank turns around and does the same thing. And it's essentially the opposite of a bidding war. You're just going in a downward direction. But there's still going to be interest on the money. At the end of the day, though, what happens is there's so many other factors. And I think April was a perfect example. There's so many other factors that play into the interest rates: stock markets, treasury bonds, mortgage-backed securities, consumer confidence, that all that kind of mixes together like ingredients in a cake. And the end result is essentially the mortgage interest rate. So, you know, I'll kind of wrap up here real quick, whereas, you know, for certain credit profiles, rates are phenomenal, right? But the problem is that a lot of people who may not be that quote unquote ideal customer, the adjustments to the interest rate, such as credit report, LTV or loan to value, the program itself, all those things compound to the point where, you know, if you're on the lower spectrum of, you know, the credit score, not putting any money down on conventional financing, your rate may be abnormally high based on where you would perceive it, but that's just because of the market and the climate that we're in. So once we get past all of this craziness with the virus and things get back to quote unquote normal, then you should see rates stabilize. You should see things get back to normal, where across the spectrum, you should have very competitive rates for everyone who qualifies. But right now, those really, really good rates are for a very specific credit profile.
Okay.
Because for the lower credit, it's a more risk factor. Banks are really tight. They don't want to lend it to everybody else.
Yeah, and I think Mr. Gupta said it best, and Gary, really, that was great. I mean, he explained it perfectly, but basically, and what we call it in our business is that you kind of you're basically pricing the product out of the market.
Exactly.
So it's kind of, and I know we all do FHAs and different loans of that nature. It's like, well, yeah, we do have 3.25% available for 5.5 points. And the customer is kind of saying, well, why does that cost so much? Because your credit profile is that it's so risky right now based upon the liquidity that we have, is that if you're going to get that particular mortgage, you're going to pay for it. Yeah. And I mean, that's really a layman's terms way of explaining it. And all of us have seen those different adjusters with the different credit score profiles. We'll get into underwriting guidelines a little bit later, but that's just something I think as a consumer, it's also helpful because now it realizes, you know what, if this is, who knows how long that this credit market is going to last with these guidelines. It's really an incentive to improve, try to get your credit score above that 680, 700 threshold, which a lot of banks are looking for, so you can put yourself in the best possible interest rate environment.
Right.
Okay, thank you. So what is bankruptcy and what is foreclosure in your world? And how does that affect people's ability to re-enter back into the market to repurchase? In,
Almost scream at once.
I feel like I'm like dominating the show right now.
No, you could. No,
Go
we're
ahead,
all,
go ahead,
we're
go
all
ahead.
bouncing. I mean, we're all
It's a
bouncing.
lot of,
I would say, and I'll just start with the bankruptcy. I would say that bankruptcy used to be two kind. Actually, at one point, it was one kind of bankruptcy to me in the lending, which was a Chapter 7, which was a forget about it. And long gone are the days, and I think we've all been in the business a while ago. I rarely see Chapter 7s anymore at this particular point. I see a lot of Chapter 13 bankruptcies, which are repayment plans and things of that nature. So bankruptcy doesn't mean a death sentence on purchasing a property, but with FHA, it's definitely going to be a 2-year from the time of discharge, 24 months. So that's something that we'll touch on, and then I'll let Gary. Maybe you can do VA, and then Mr. Gupta might do conventional. We can kind of bounce off the ideas that way.
Sure.
I think conventional it is 4 years.
Yeah, 4 to 7.
4,
Yeah, 4 to
7 is
7.
for the foreclosures.
Yeah, extenuating circumstances in certain cases,
Right.
but I've never seen, I've never had one. Yeah.
No, yeah, and that's actually an extenuating circumstance by, I guess I'll say HUD, which is FHA. Their definition is, I would say, point blank, death of a primary wage earner, period. That's it.
Yeah.
I've had some really sad stories that I've tried to put through. Underwriting's agreed, but you send it out to FHA and they say no. And there's nothing you can do about it once they say no. But to get back to your original question, I feel like a lot of times foreclosures and bankruptcies really go hand in hand, but they're extremely important to make sure you understand the difference. A bankruptcy is basically, specifically Chapter 7, where essentially you're in a situation you can't do it anymore. You got to throw up your hands and just say, I got to restart, for whatever reason. Okay. That forgives you of the debt. Okay. With a foreclosure, that's where essentially the bank has now repossessed the property. And those may sound the same, but they're completely different, and it becomes a stumbling block, which most consumers don't understand. So you can actually include a mortgage in a bankruptcy and continue to live in the house. I've seen it for 3, 5, 7, 10 years. Okay. Where the bank doesn't actually repossess the property and turn it over. And the reason being, this is probably a little bit of truth, a little bit of my opinion, is that if you're living in the house, you're going to maintain the house. You're going to pay the taxes. You're going to pay the insurance. You're going to keep the grass cut. You're going to keep everything in working order. Whereas if once the bank takes it, now that bank is now the responsibility of the bank, and whoever in it, they kick them out. So now the bank, until they can sell it, has to pay the insurance, pay the taxes, maintain the property, make sure utilities are there, make sure everything's upkept. So, and a lot of times people will include the bankruptcy or include the mortgage in a bankruptcy,
Right.
and keep making payments voluntarily. And if you've ever seen a statement, it actually specifically says, we are not sending you this notice to collect the debt, which means the bank stops reporting the collection of payments to the credit bureau. And until you've actually seasoned the foreclosure, which on FHA is 3 years, VA 2 years, conventional 4 to 7, your seasoning requirement for that 3 to potentially 7 years never starts. And so if you have a bankruptcy, especially if you've owned a property, you need to make sure if you're going to keep maintaining that property, you reaffirm the debt, which is essentially where you go to your bankruptcy attorney and say, I'm washing my hands of all debts except for the mortgage, because now you're only seasoning the bankruptcy as of the discharge date, not the foreclosure, which would be as of the date that the bank transfers that title to someone else, which is ultimately when the bank resells the property. So I've had multiple scenarios where I've looked at credits and I've seen where they've, done the bankruptcy, included the mortgage 10 years ago, but the bank didn't resell that property until 2 years ago, and they're just out of luck.
Yeah.
And they're like, no, I included it. Well, they're two
You can
completely
you can
different
do a
things.
refinance. You can do a refinance if you reaffirm that mortgage. You can do a refinance, put it under your name, and then done with it. So that you can do that also.
Wow, that's a lot of technicality. I'm just like, whew.
Yeah, exactly. That's a
Yeah.
lot.
One,
So
one
you
thing I
can
would
do
add.
oh, sorry.
No,
Go
no,
on.
no. One thing I was going to add to Gary is that I think we would all agree, because it seems like all of us, we might have similar lending backgrounds in helping customers. Bankruptcies and foreclosures are definitely not mortgage death sentences at all.
No.
They're timetables that are attached to them. But specifically, what I really try to stress to consumers, just from, because we're all also professionals, is that lates after the bankruptcy is one thing I highly, you cannot have lates after bankruptcy. Because essentially specifically with, let's say, government agencies like, and we'll talk about VHDA a little bit later, they look at it really, really with a fine microscope, because basically what you're saying is that all of my debt has been wiped away. I have a new start, but even after the bankruptcy, I was having financial issues and troubles. And I always say to clients, if you were the lender, would you lend you money? That's the best way to look at it. And if you would say, I'll be a little bit hesitant, well, think about a bank that wants to lend you $300,000 or $400,000 if you've already had a previous financial extenuating circumstance, and now you're getting back reacclimated, you got your job back, you're back on your feet, and you're still having late payments. So if you do have to go through those, think about it from the right consumer standpoint. No late payments, paying your bills on time, keeping credit and things of that nature to a minimum, even after reestablishment. Because in our business, and I think you guys can attest to this, sometimes clients, after a bankruptcy or after foreclosure, they go out and they get a whole bunch of a ton of new credit cards. And then in a 6-month period of time, I'm telling you, Anita, it's like clockwork. You'll see one small late, two small late. Keep everything at a minimum. Become a cash cow. Start thinking like, you know what, I'm going to put money, whatever you have to do to keep your expenses at a minimum, that's what you should be doing. But that's one thing in 15 years doing this, it always gets a client, it makes their loans hard to get approved. And sometimes they don't get approved at all. Trying not to have lates after you've had that bankruptcy or foreclosure, because lenders are really looking at that. Specifically now in our credit climate now, the expectation should be, if the microscope was this small, now it's going to get this small.
Wow, that is good information. So what I'm hearing is, even though you may file bankruptcy or be in foreclosure, you can still come back and repurchase, but you have to keep your bills in order, like making quick payments, living within your budget to make sure you are at a good credit space where you are credit worthy for lenders to give you money to purchase.
Right. You said it perfectly.
Okay, that is good information. So I think we've talked about, no, let's dive into the different types of financing options. So I know we have the VHDA, the USDA. These are acronyms, everyone. The FHA, the VA, the conventional 203K, no down payment grant program. So each of you have your own specialties. You all do FHAs and conventionals, but I know because I've dealt with all of you, you all have small, unique specialties. So let's start with Gary. Your no down payment, 0% down program, how does it work?
So basically what it is it's a FHA loan, or you can do it with conventional. And what we do is we have a couple different options. The most popular is our FHA, where you get a 3.5% second. That can either be paid over a 10-year period, so that you're repaying the down payment, or you can have a 3.5% second, where as long as you make your payments on time on your main loan for 36 consecutive timely payments, not more than 30 days late, then that down payment, the 3.5% is forgiven. Okay. It's pretty cool, just because it's a lot more lenient than some of the other bond programs or down payment assistance or grant programs in terms of debt to income and credit score requirements. And especially right now, the rates are literally insanely competitive. Across the board is 3.75%. You do not have to be a first-time home buyer. There's no income restrictions or caps on it. You know, depending on how much you make, it does sort of change how you have to structure it slightly. But that's probably a little too much detail for now. That's something that, you know, we typically deal with on a case-by-case basis. But it's really kind of just an opportunity to help people who, you know, are in a situation where they just don't have the money to put down. You know, just like with any program, which we'll probably hear about in a second, there's, you know, pros and cons, you know, with it. Of course, you're going to have a higher payment because you're looking at 100% financing. But for people who don't have the down payment, it's a wonderful option to consider. So that's
The minimum
we
credit
use quite a
score
bit.
on those?
I'm sorry?
What is the minimum credit score?
620 is the minimum credit score for those. You know, I usually prefer and recommend trying to get at least to a 640, just because with the program, there's an automatic 1% origination fee, which is 1% of the loan amount that gets added to the closing costs, which, you know, can be paid by the seller through seller concessions. Or you can finance it in if the appraised value can support it. But once you fall below the 640 mark, you also now have to add in discount points. So you may have an additional 1% discount on it. Again, that's going to be one of the cons against the program. However, you know, if you're in a situation where, you know, you just have to move and your down payment's not readily available, you just have to look at negotiating it into the contract one way or another.
Wow, that is really good information. So this is for owner-occupied properties that you are
Correct.
buying to live in, not investment. Like you
Correct.
said.
Yeah. It's going to be primary homes only. You can have non-occupant co-signers. And as far as, you know, the income I was talking about before, it's only qualifying income, not household income, which we could probably cover that on either USDA or VHDA because that becomes relevant on those programs.
Okay. So, Aaron, you want to dive into VHDA and 203K loan programs that you offer?
Okay.
I mean,
Yeah,
all these loan officers offer all types of loans, but they offer FHA conventionals, but they have specialties. And Aaron, I know, is specialized in 203Ks and VHDA. So if you have a lender that cannot do that, he can do it for you.
I'll tell you what, before you get started, Aaron, the 203K, that's money. And if you know how to do that, and just as far as Facebook Live is concerned, if anybody's looking to do a 203K, call him because I've attempted them. And I don't know if it's just because I don't know if it's just because I'm too old or I'm in my way.
You ain't old, man. Whatever.
Nah, tell us about the 203K because that's a money deal right there.
Yeah, it's funny because the property that I'm in right now, I got a super deal on it, and guess what kind of loan I did? I did a 203K. I did just because I know how to do them. But a 203K it's an FHA-backed mortgage, but it allows you to take the purchase price and the renovation amount and roll that all into one. So I'll just do a quick basic scenario because I've taught this class for about 10 years. House costs $100,000. You want to put $50,000 into it. Let's say do a new kitchen, new bathroom, finish the basement, things of that nature. Your total down payment is going to be based on your total acquisition cost, which is $100,000 for the purchase price, $50,000 in renovations. With an FHA 203K, you're putting 3.5% down of $150,000. There are other fees and things of that nature involved, but the essential transaction, that is what it is based on. And that's the best way to think about it. The good thing is that the lending is done on after improved value. And that's what actually worked out for me. With after improved value is that the bank is going to value the property, not in an as-is condition. That's extremely important. So it could be what we call a total dump. But if the after improved value, let's say you buy it for 100, but the after improved value is 180, the LTV and everything is going to be calculated based upon that. So you're actually getting in there and getting a great deal, getting all those repairs and everything done. All repairs are done after settlement, which is also fantastic. So you can do plumbing, HVAC. I mean, I've done mold remediation before, which was okay. Brand new well and septic systems. You can even do what we call pop the top, which is literally as long as a structural engineer says that the property can be excavated and can actually handle whatever the addition is, you can actually add an addition to a property. So a lot of times the reason why that program is really, really important is that Some clients, depending on the price range or depending on where they're looking, some houses, every neighborhood, you might want to be in that great neighborhood, but you found that house that needs a little bit of work and you've got to put a little elbow grease into it. It's a great option available. So the rates are going to be higher because banks are also lending on after improved value. So the interest rates are definitely going to be a little bit higher. In this lending environment, they're going to be a lot higher because this is a very, very risky product. But, you know, everything is risky, is risk and reward. So we have also the home style renovation, which is the conventional product, same exact concept where you can renovate the property and you're also just doing conventional financing, actually going to require a higher credit score. Typically with a 203K, the guidelines used to be you had to have a 640 credit score. Now you're probably talking 660 to 680 at a minimum. I personally would recommend a 680. You want to try to get that credit score as high as possible in this lending environment because the interest rates are going to be a lot higher. So yeah, I love 203Ks. They're a great product. I think for a lot of people, for a lot of investors I've learned with over the years, it's been their first introduction to working with contractors and understanding the construction process. So if you want like a beginner's guide, you have to have a licensed contractor. It's a really, really good way to try to get into the process, working with the contractor from start to beginning to end. The other good thing about a 203K is that the lender it's in the best interest of the lender to protect you during the transaction. So you have to have what's called a HUD inspector, which is somebody that actually goes out, make sure that all the work and the repairs are being done. And actually that person makes sure is that the bid that you get from that subcontractor, that contractor you're working with, is along normal price points. That's extremely, extremely important because I had a customer, they were looking to redo a bathroom, contractor gave them, said it was gonna be $55,000. This was a really, really extensive job. HUD inspector came back and said, this is a little high, it needs to be at 42. Numbers got adjusted down. So those are the protections that consumers have when doing a 203K loan as well. So obviously, I teach CE classes on this, so the class is like 2 hours long. So I just tried to condense 2 hours into about 5 or 7 minutes, but I hope that made sense. But yeah, 203Ks are really, really great products as well.
Yeah, I can personally attest to it. I have experience doing that. And it's for, if you're a first-time home buyer, you can certainly do this program. It's not as scary as it sounds. You will have the contractor from the onset that your realtor, myself, or you can also bring your own contractor. They will look at the work. They will give you the expense, just like Aaron said. They will let you know how much it's going to cost for the whatever renovation that you want to do with that house. And then we are attacking the renovation amount into the loan. So it's a really awesome option if you want to buy a fixer-upper. You know, you have a vision, and it's like the homes out there are so expensive, but you can get a good deal and just do this renovation project. So for first-time home buyers, experienced buyers, you know, it's a really, really great product. So thank you for that information. Now, VHDA.
Oh, I gotta go again. VHDA, I love VHDA. Virginia Housing and Development Authority. So literally, the consumers out there, VHDA.com. It's a bond program sponsored by the state of Virginia, which has it's a first-time home buyer product. My favorite is the VHDA grant with a conventional or with an FHA loan. And basically, in layman's terms, is that if you put up 1% of your own money, so if a house is $200,000, if you put $2,000 into the transaction, VHDA will either give you a 2.5% grant or a 2% grant that does not have to be paid back. The reason why that's so important is that you instantly created equity in that property. And if you're thinking about it from a long-term real estate investment prospect, that's a huge, huge way to start, is that your first property, you literally created 2% of equity, but you could have gotten the same FHA loan, but you just borrowed VHDA's grant funds. Also with the VHDA loans, you're eligible for what's called an MCC, which is a mortgage credit certificate. That MCC, and I know they just changed the guidelines, so don't quote me, but it's gonna be based, I think it's income based now, to where it's gonna be a certain percentage of your income, which is a flat tax credit. Before, it used to be $2,000, which was if you made $75,000, as long as you had that mortgage through VHDA, you would get a tax credit on your bottom line. So not only were you able to get a grant, you're also getting a tax credit as well. This is one aspect of VHDA that a lot of people don't think about, but their home buyer education is fantastic.
It
And
is.
their class is fantastic. And for people that really have, even if you're talking to your loan officer and you're getting all the right information, but you really want to dig into a really, really good course, I highly suggest taking that VHDA online class. It's free. All you have to do is have an email address. I know that might sound pretty sarcastic, but you can take that class. It's good for 2 years, and you learn so much just about the process, the different expenses, from start to finish, budgeting. I can't tell you how many clients that we've had to go back and forth with underwriting, and if you've done VHDA before, hey, we need a budget, and clients are really sitting there saying, Aaron, you know what I learned through this process? When VHDA made me sit there and do that budget, and it really opened my eyes. So check out VHDA. They have conventional products as well. They also have an FHA product or conventional product where you can have a second trust. It's totally different than Gary's, but basically the second trust acts as your down payment. So whatever your rate is, let's say your rate is 4% on your first trust, your second trust rate is going to be 4% as well. It does have income limitations as well. There are sales price limitations. So it really depends on the county that you're looking to purchase in, but VHDA is a great product as well. And it's really provided a good opportunity for families to become real estate investors.
Yeah, and I think one of the things that also is really awesome about VHDA is their rates. Like they have extremely low interest rates, mainly because it's sponsored by the state.
Yep.
Also, they don't run out of funds, which is something that will become relevant come October for a lot of the government programs. So as long as they're in business, I know they do have limitations. But the way they budget it out, the way they plan it, because I did VHDA for about 10 years consistently, and I had never on one transaction ever been in a situation where they said, sorry, we don't have, the money available.
Yep.
Whereas, with USDA, pretty much every September, October, fingers crossed.
Look, Gary, don't write a contract, right?
Or at least you better get that registration in quick.
Yeah. Oh, the other, I appreciate that, Gary. The other thing about VHDA is that even in this credit climate, I was actually able to speak to one of the top executives when everybody else was restricting, because they're a bond program and because they service certain communities that are impacted, they did not change their credit guidelines. They adjusted their pricing. So their rates did creep up a little bit, but you still can get a VHDA loan with a 620 credit score. So, I remember, everything changed, but you're talking about families that can get a grant, have a 620 credit score, and immediately move into a property with equity and have the MCC, which is the mortgage credit tax certificate as well. And they're getting quality home buyer education. So it's really a phenomenal program, but all these programs are phenomenal. You just got, as a consumer, you got to figure out which box you fit into.
Right.
Is Gary's program going to work? Is VHDA program going to work? Is Mr. Gupta's? Which box do I fit into? And then making sure you're getting the right kind of professional to guide you through the process. Yeah,
and the one awesome thing about VHDA is they're all wonderful people. And I think, I was doing it for, I don't offer it anymore, just being completely transparent. I don't offer it anymore, but I still, the people at VHDA, they genuinely want to just help people. So, they understand life happens. So if you're in a VHDA loan and, you need help or you're having problems, they are always just a phone call away. They do their own servicing. So they kind of call shots in terms of this is how we can help you, whatever, as opposed to kind of dealing with call centers and whatnot through regular servicing. So, VHDA is a little bit more challenging to qualify for, but
Yep.
If it works, they are a phenomenal organization, phenomenal group of people. And even though I do not offer VHDA personally, 100% endorse the program and the product. They're that good. So.
Oh, you guys are
Yes,
so
sir.
kind. You were a great bunch of panelists supporting each other. Thank you so much. So,
Yeah,
Mr. Gupta, talk about conventional and general FHA.
I don't know where I stand. These guys have covered all of it.
Look, there's more money out there.
I don't know. Right now, what I'm finding it a little different is that as an FHA, I'm able to still do it with a credit score of 580, and the rates are not that bad. Able to, because I know the investors are not doing it up to going for a 620 or 640. They are not taking any of those. I don't know if that makes a difference right now in the market or not, because everybody else was able to do that. I guess I'm trying to figure out where the niche is. Of course, I do conventional loan with a higher credit score and all of those things. The rates are excellent, those things.
We'll talk about like the down payment requirements. A lot of times people
Yeah,
assume
what
you
is
need you
needed?
need what, 20% down if you're going to do a loan.
Yeah, Gary, I was gonna. Do you do Home Ready and Home Possible? Because I do a lot
Yep.
of those as well. Yeah,
Yes,
Home
yes.
Ready is a
So
fantastic.
Home Ready is
program.
awesome.
Yeah.
Yep.
The Home Ready, Home Possible is it's not for a first time home buyers as well. It depending on the income driven. And they get a good 3% down with the income and,
Do you do VA loans?
VA, I don't do a whole lot. I can do it, but I'm not, my market is not for, my
Gotcha.
market is mostly like conventional loans and FHA and
Okay.
kind of a,
So
I am.
the conventional, what is it? The 3%, 5%, 20%? Because when people hear of conventional, they are thinking 20. But I know you have like 3 or 5% programs. Can you emphasize?
Right. So you do it minimum you can do with 3%. Like Gary was talking about, even the 1% is a conventional loan. So that what is happening is FHA is getting more strict, where conventional was making it more easier for the borrowers to go that route. The advantage now we are finding it as a conventional, you're putting 3% down. Your PMI will eventually go away. FHA loans, PMI will never go away. They would charge you a front mortgage. So if you have 680 or so and you can put 3% down, you can go into a home ready, you are better off going as a conventional rather than the FHA. So my criteria usually is first I try to figure out, is there a way I can do it as a conventional? I mean, like, you can even do as low as 620 if DU approves it. In a longer run, conventional could be better because of that upfront mortgage insurance and the PMI factor. Even for a lower credit, it may be a problem that the rates are higher than the FHA loans, but then you can get rid of it. So
You got your
that's a very
LPMIs.
big advantage.
Your
So the
LPMIs where
PMI
you can, huh?
Yep.
The PMI is a private mortgage insurance thing that benefits you lenders, right?
No.
No.
No, it
Have
kind
Mr.
of
Gupta-
makes us all mad, truth be told.
Yeah. So yeah, hey, Mr. Gupta, tell us about LPMI because that's huge, especially out in Loudoun County when certain clients don't have 20% to put down but refuse to pay mortgage insurance.
Okay. Well, nowadays most of the time I tell them to pay the mortgage insurance because LPMI is basically you are paying a higher rate of interest on the whole loan amount. Whereas when you pay the PMI, right now the PMI rates are so excellent. The credit score is good. I mean, they are very cheap. Rather than go with the PMI and then gradually as your principal is going more, PMI will go away and then eventually go away.
Sure.
Yes, but you have an option of paying a lender paid PMI. When I bump up the rates, they will pay it, or you can pay at one time the whole PMI, so it doesn't. Sort of touch wood. I have been able to convince people not to go with the lender. I don't like. I don't sell it, because
in the right circumstances, the situation. If you know you're only going to be in the house for usually the payback period. If it's more than 6 years, typically you don't want to do it. But it's just options that don't exist or only exist with conventional that don't exist with other programs.
FHA, you have to, even if in a FHA you are putting 20% down, you still have to pay the PM.
Exactly.
And those MI premiums, and I think Gary, Ali really had some great information, but those MI premiums, if the credit score, as we all know, it drives that, because I've seen like the difference between somebody having a 680 credit score, getting monthly MI, and somebody having a 720. And when I say night and day, it's literally like night and day. Somebody says, well, 40 points. Even from a 680 to a 700, those single premium factors can be high. The monthly factors, you can forget about LPMI. I had a buddy. No, I'll give you a quick story because stories always help. I had a buddy of mine, Anita, in Atlanta, and he doesn't do conventional at all. And he called me. He was like, "Yeah, I got a 660 credit score, and she's trying to do PMI." And I said to him, "Why?" And he looked at me. He was like, "What do you mean?" I said, "Run the factor and then compare it to FHA." And he said, "Oh my gosh, the factor's like 1.5%." And I said, "Well," I said, "what do you want me to tell you?" I said, "What do you want me to tell you?" But PMI, it's credit score driven. It's risk driven. I mean, it's just private mortgage insurance is risk driven. And so the better the credit score, the better the MI factors. But I mean, Mr. Gupta, we all have products where you can do a home ready with 3% down, 5% down. I mean, there's so many great conventional products that are available to clients. And 3% down, that's a great option to either, become, I always say you're starting your real estate portfolio, even if it's your first property. It's
Right.
one of many.
Yep.
And if you can get into a house and you find a great deal and have a great agent such as yourself, and you can get in with 3% down, it's a win-win situation.
Yeah. I don't think consumers should let the PMI thing deter them from moving forward with their goal of home ownership. I mean, I think when you get 20% value or equity in the house, PMI do come off your mortgage payment. So it's still a good product to have that option as financing.
I will say, because of where we are all geographically, we would be doing a disservice to our customer base or anybody who might be watching if we don't talk about VAs. So do you want to do VA, Aaron?
VAs are my favorite loan in the world, man.
Well, then save some.
I love VAs.
Save
VAs.
some for me. Go ahead. Tell us about VA.
I'll do a little bit, and then you do.
All right.
Yeah, VAs are for any retired, any current or retired military, also reserves. If you're in the reserves, you are eligible. We have to check the guidelines, but literally you have access to 100% financing based upon your eligibility. The interest rates are phenomenal, and I mean phenomenal with a VA. The one thing I love about VA clients, it's actually, to me, Gary, it's the selling point even before the deal, is that you can actually get into a VA loan now, and then if rates drop within the next 6 months to a year or whenever they drop, you can actually refinance that loan without having an appraisal. And they say, really?
Or income.
Say, no money out of pocket. And they're like, wow, I have a guy right now, this is his second one. And he's like, man, I just did a rate and term a couple of years ago. And now he's like, what are the rates now? And I went over it, and he's like, I still have no money out of pocket. I say, as long as you're a veteran, and I don't think that's going to change. So VAs are great products. They have the loan limits are phenomenal. I want Gary to talk about that, where you can literally now, you can do some really high level financing with a VA loan, which I think a lot of consumers are not aware of that, particularly in this kind of environment to where, let's just be honest, we're dealing, the DMV area, this is an anomaly for most of the country. The only other place I can think about is maybe San Francisco or New York, and I'm a New Yorker, to where the prices we have for like your average sales price being in the 4s and 5s, we kind of blink at it and don't pay any other attention to it. The average sales price in the United States is anywhere between $250 to $260. Mm-hmm. So when people hear about our prices here, they're like, really? But for us, it's just kind of common knowledge, and it's just the way that it is. But I want Gary to maybe talk about some of the other aspects of VA that people don't like about. I really like that high balance thing that we're seeing in the VA market now.
I think nowadays there is no limit. Right? There is no limit to it.
They took away the lending limits on VA. So yeah. So I mean, in addition to the rates and stuff, no money down and no mortgage insurance, period. Okay. If you have more than 10% disability rating, no funding fee. Which even if you take a conventional loan 20% down, VA loan 20% down, usually the difference in the interest rate between conventional and VA, even with a funding fee, is still going to be cheaper. So VA is really awesome program. One of the biggest misconceptions that I probably hear and see is that a lot of veterans think they only can do it one time. They can only use their VA to buy a loan once. Not only can you use your VA multiple times, but you can also have multiple VA loans at a time as long as you're securing them on primary residences. And so, with loan limits going all the way up to, they don't have loan limits now, but most recently you know, the loan limits were, you know, most recently at like 840 some odd $1,000. I mean, at the end of the day, think about this. The VA was signing off on 800, I think it was 843 and some change, 800,000 plus, no money down, no mortgage insurance. Oh, by the way, let me sweeten the pot and give you a 4.25%, 4% interest rate. You want to pay a point? Fantastic. We'll drop it to 3.75. So, you know, the VA, you know, especially, you know, if you're around military bases, you know, the key thing is you have to be, you know, a veteran. I believe it's what, served at least 2 years, and or have honorable discharge.
Yes.
Now, in some cases, you can have other than honorable, as long as the VA signs off that, you know, they'll back your insurance depending on the circumstances for which you departed from the military. Phenomenal program. Definitely, if you can, if you're eligible for that, highly recommended. I personally, I very rarely will point somebody and say, you need to do this program. I usually say, here are your options, here what it looks like, you know, let me know what best works for you. If you are VA eligible, I will point blank tell you, you're doing the VA loan, because that is, in my opinion, and based on everything I've seen over the last 15 years, I've never seen a loan outperform a VA loan, period.
Yep.
So I can go out, if I'm a VA personnel, I can buy a $2 million property with no down payment. That's what I'm hearing, right?
Gary, is it there is not much of a income DTI ratio also on the VA loan?
No, they don't. Now, to be honest with you, I haven't gotten familiar with the VAs since they've taken away the loan limits. Most of my price points tend to be less than 600,000. So I've never had a reason to look into going higher than that. But if the VA has removed the loan limits, then in theory, you could. But my question is as a veteran, like, let's be real, most veterans know you don't really get paid. As a veteran, you would not be able to cover a $2 million mortgage at 100% financing. Huh?
I was just being hypothetical.
Yeah. I mean, in theory, I guess it could be done. Practicality wise, probably not.
Yeah.
I mean, you do. I mean, I priced a 900K one out the other day, and it was a similar, exactly what you said, Gary. Former veteran, now private security industry now. Okay. So looking to use his VA, not sure what direction he wants to go, but he's looking like, hey, do I want to do a conventional or do I want to do a VA? And the VA, as you guys know, looking at these high balance jumbo rates right now, the VA look really attractive.
Sure.
Extremely attractive. So yeah, there's definitely opportunities there.
Awesome. So, did we talk about USDA, which works the same way as VHDA? Can someone just brush over it?
I like the fact that we have transparency. Like Gary said, I haven't done a USDA loan in maybe 3 years, and I used to do a ton of them because when clients come in and we start to, like I say, I'm talking to my clients as a counselor as well a little bit with financial advice, and I'm like, if you can get a VHDA and move into a property with equity, unless you have to have 100% financing, it may or may not be the best option for you. I'm not familiar with the USDA guidelines. Maybe some of you guys, I know that it's U.S. Department of Agriculture. It is for rural areas. So the best thing to do is to talk to your agent to get that address and get that address over to your lender immediately to make sure that that property is eligible for wherever you're looking at. I know where I'm at in the area I live. I live in Culpeper, Virginia, but Culpeper, Orange, Spotsy, all USDA territory. But then you have some parts. You have like a little part of Prince William, like a half a street.
That's that part of Prince William where you don't know that you're still in Prince William.
Yeah. You know, like it's
that's when that's that Prince William part. That's that part of Prince William County where I come outside, it's sunny and 80 degrees, but yet they close school because it's snowing.
Yeah. You know what I'm saying? Yeah, but yeah, USDA, it's a great program. They have income limitations as well. It's 100% financing. And I believe they charge an upfront fee. I'm not exactly
1%.
sure. Yep. Yeah. You said how much, Gary?
It's the upfront fee. It's a mortgage insurance premium similar to FHA. It's a 1% upfront mortgage guarantee fee. The huge highlight on USDA if you can find a house in the area, in geographic area, and fall below the household income limit, is the mortgage insurance premium. The factor is 0.35, whereas with FHA it's 0.85. So you're literally looking at almost a third of the mortgage insurance and then only 3/4 of the upfront premium. So overall, it's a much lower payment than FHA. But again, it has its pros, its cons. The cons are going to be you have to be in a geographically or geographic specific area. The income limits are also much lower than VHDA, and their DTI requirements are very tight and very strict. So again, if you fall into that category and it works, yes, you would want to do USDA all day long. But it's just another one of those, you got to weigh the pros and cons, where you fit, what your options are. But, kind of side by side, that will definitely be a little bit more of a beneficial program.
Okay.
Also, Anita, third-party approval. And I know Gary, you sound like he was about to touch on it, but this is when we say third-party approval, this is real third-party approval.
Sure.
Which means that once Gary's company or Mr. Gupta's company or mine, we approve it, we have to send that loan to USDA. And if they say those turn times are 5 to 7 business days, those turn times are 5 to 7 business days, and that's non-negotiable. That's extremely important for your client to know upfront during the process, because it'll help you to write the contract. But also, a caveat to that is that every morning we get a report that says on Monday the turn time could have been 3 days, and Friday the turn time is now 7 days. It's all based upon volume. So those are really, really important things to remember, is that you're getting the money from the U.S. Department of Agriculture. We're helping fund it, but it's a third-party decision. And sometimes they might have additional loan conditions that the consumer has to meet that can delay the process as well. So giving consumers proper expectations about exactly the transaction and the product that they're getting into is extremely important as well.
Yeah, and then of course the funding has to be available. So whenever you have, seems popular to meet recent years where the government can't pass a budget,
right?
Guess what? No USDA funding, you're on hold. So again, it has its challenges. However, just like with every single program, pros, cons, those are going to be some of the cons. But as long as you're working with a professional that can kind of keep you updated and give you those expectations up front, phenomenal route to go.
Okay.
Absolutely.
So you guys keep throwing acronyms, DTI and all what is DTI? I know it's debt to income ratio.
I was gonna say death to income ratio.
I'll be quiet. I'll sit this one out.
No, I'm sitting it out too. Mr. Gupta, go ahead, man.
Okay.
Let's talk about
How much money you make?
loan qualification. You guys have been talking about the market being different now. Regulations, new regulations have come to play. So what are the new credit scores? I know you touch base on it when you're talking about the different programs, but if you can just quickly dive in quickly and just give us the new credit scores requirements.
Before we start, there is other programs are there where people don't have a full documentation. It's called or a self-employed program.
I was gonna get to that later on.
You're gonna get to that. Okay, that's good. Then let's show what your advice. And maybe you forgot about. Okay.
So give me the current credit scores needed for FHA, VHDA, VA. I know you touched on it when you were talking, but
Sure.
I just want.
Well, that's kind of a gray question right now, because, and it's a common misconception, none of the agencies have changed any of the guidelines. And by agencies, I mean FHA, USDA, VHDA, Fannie Mae, who am I missing? Nobody, the programs themselves haven't changed any of their rules. What has changed are the servicers' requirements for picking up these loans. So it's the companies that are actually collecting the mortgage payments. And if you think about it like this, here's how I've been explaining it to my customers, going back to the forbearance thing. If, Aaron as a lender is saying, or Aaron as a servicer is going to say, hey, I'm going to borrow, I'm going to go ahead and start collecting payments for Anita for her loan, okay? Aaron knows that when he collects payments, there's a lot of stuff that happens on the back end. Aaron knows that he's making commitments on the interest that he's ultimately collecting off of that loan to, let's make it simple, fund Mr. Gupta's 401k or whatever investment portfolio he's essentially securitizing against that income stream, times all of the millions of people buying houses. If someone comes out and says, hey, I know things are tough right now, you don't have to make your mortgage payment for the next 3 months. Well, Aaron's going to be like, well, snap. If these people aren't going to be paying these mortgages, how am I going to pay Mr. Gupta off, on his portfolios, on his retirement portfolios? So now what Aaron has to say is he's going to have to go back and look at his books and say, based on the performance history of these loans, I'm noticing that anything lower than 660 has a higher default rate. So now he has to say, you know what? I want you to have 3 months reserves in the bank. I want your credit score to be better than 660. And I want you to, whatever other rules that he wants to put in place in order to agree to purchase the loan that I want to create, for you, Anita. So what happens is when you come in and say, well, I have a 620 credit score. I'm getting all my money as a gift for the down payment. I don't have any reserves. Aaron's like, that's too risky right now. So that's what we saw at the beginning of April is everybody said, well, I will go ahead and say everybody said, you know what? We need now, although FHA will allow you to go down to 500 credit score, we are going to require for us to collect servicing, we are going to require that you have a 660 credit score. Now, me as a bank, doing your loan, Anita, I say, okay, I still want to do loans, but I can't service my own loans, meaning I can't collect my own payments because when you go to closing, I have to be able to send real money in the form of a wire from my warehouse lines to your closing so that at your settlement, your title company can pay the seller. If I service too many loans, I run out of money to lend. And if I run out of money to lend, I can't lend anymore. So what happens is now me as the bank, I have to play by Aaron's rules so that he can deliver on what he's promised Mr. Gupta. And if Aaron won't pick up my servicing to do your loan, everything grinds to a halt, which is essentially what we're experiencing right now. So the loans,
Go on, sorry.
But I was just going to say, so it's not that the loan rules have changed. It's what do we do with these loans after they close? Because there's a high probability that their forbearances are going to come into play. In the month of April, forbearances went up 2,000% in the first 15 days of April once they put that announcement out. So as servicers across the board, when you're seeing those type of numbers, you're scared because you still have to deliver. You still got to make your obligations just as consumers still have to make their obligations. And so that's what we're experiencing. That's what we've seen. That's what we're trying to navigate right now. So as we get more clarity from the government and from, the different agencies that are supposed to be helping, the servicers with this, then we'll see hopefully guidelines loosen up to back to what the agencies allow, which will then free up the money markets. And because everything is all jacked up, with the amount of money that the government's pouring into mortgage-backed securities, trying to keep everything as stable as they can, then you'll see rates level out and I will actually go on this call on record and say the rates will be very low for a very long time, period. Because there's no way that the rates are going to be able to tick back up to what they were projected to do previously.
Especially with the way that unemployment is looking as well.
Exactly.
A lot of this has to do with our health as a country. We're going to start to see a lot of changes. I think, Gary, that's probably, truth be told, that's been probably the best explanation that I've heard about it. Another guy explained it. He says, think about if you owned a business and all of a sudden you had 100 customers and 10 of them said, we're not making payments for 6 months.
Mm-hmm.
Now you have a certain level of reserves, but how quickly do you want to go into that reserve bucket? And now you're starting to think, well, what happens to the next 200 customers that we get in? Because we're all lending money. We're like Gary, it's the best explanation. We're all hedging that money on something else. It's all being lent based upon another financial instrument, mutual fund, for whatever you're thinking about. And remember, servicing is an income as well. So lenders are actually buying the right to collect payments. If you have a portfolio that you clearly have enough, like Gary said, enough data on to where there is specified data that says there is a portion of this portfolio that is going to be non-performing for the first 6 months, you don't want to buy that portfolio. And as a matter of fact, you're probably going to try to figure out a way how to rule out some of that portfolio from any of the loans that you're purchasing. And that's how we got to where we are.
Yep.
Bottom line is right now, if the credit score is 660, that is a good way to start. There are few investors who are still doing with a lower credit score, but how soon they're going to go away, no, we don't know. But 640, 660, that's the benchmark.
So what I'm hearing is the regulations are still intact. It's just the investors are driving the new changes, right? Because they don't want their monies out there, and it's just
They can't take the risk.
It's
Yeah,
all
I'm
risk-based.
getting that.
Everything is risk-based at
Yep.
this point.
And I'm actually kind of happy to see it. You know, truth be told, yes, it's made, I think we would all agree, it's made our jobs a whole lot more challenging, to say the least. But unlike 2006, it probably was the right thing to do, rather than just to let, because at the end of the day, none of the three of us, I think, really good loan out. Nobody, you know, of course we all want to get paid, but we don't want to see people homeless. We don't want to, you know, Anita, you know, I have a motorcycle license, and one of the things that they told us in the class was, when I got my license, was please be responsible. We hate when we see articles where we know somebody in our class killed themselves on a bike. Same thing. To check back with a customer just to say, hey, how are things going? It's the worst, and I've dealt with it personally. It's the worst to hear that they fell on financial hardship and they had to foreclose on a loan that I created, because now I'm second guessing. Did I miss something? Was there something I could have done different? Did I give them all the information, or, you know, is it just life happened? You know what I mean? And so I'm glad that, you know, they're being more strict, even though it's made our jobs difficult. And for the most part, I think customers get it and they understand it. But in the same way that we all, of course, have been advised to wear a mask in public for the better of the public, whether you're sick or not, same thing, going back to the forbearance, make your payment, whether or not, you know, if you can, make it, because it will be better for the economy as a whole, the more people that are keeping up with their responsibilities is really what it boils down to.
I truly love the honesty and integrity, the level of integrity you guys bring to the business. That is really awesome.
Hey, Anita, can I add one thing to what Gary had
Yeah.
said? In reference to just guidelines and giving clients proper expectations, one thing I know that we all pride ourselves is for clients to have a good lending experience from start to finish. One of the main things that I know as a company we've been talking about, and I'm sure you guys work for great organizations, is that giving clients proper expectations about specifically right now, what is going to happen. You might have to be asked for another verification of employment. Don't be surprised if someone is asking you for an additional pay stub. We actually had, and a couple of friends of mine in the business, they were like, Aaron, I've had investors say, we need a verbal day of settlement.
Yep.
All of us have been in the business for all of us have been in the business for a while. So we know 10 days were the standard. 10 days out, we're not in that environment anymore. I can give a personal testament to where we had 3 loans closed 2 weeks ago. The day before settlement, underwriter was like, Aaron, you better find me a manager or somebody that's going to do this verbal for this client, or otherwise I can't sign off on it. Now, mind you, think about the environment that we're in. Everybody's working from home. It's just a different lending environment. And I'm saying that so clients understand it's not abnormal for these kind of things to be happening. Additional information, day of, just be prepared for it, because it all falls back to what Gary says, is that the level of risk that we want to take on. And we have to sell these loans on the secondary market. So we want to make sure that we're being over conservative. And I think that if consumers take on that aspect and take on that thought process, it'll lead them to having a better lending experience, because everybody has proper expectations. This is not Gary being a jerk. This is Gary actually doing his job to protect me. This is not Mr. Gupta saying, why do I need another pay stub? I gave you one last week. It's because the lenders want to make sure they can give you $500,000. Right. I know that might sound sarcastic, but no, they want to lend you the money. So proper expectations and having everything in line is going to lead to all of us as an economy, and makes everybody's job easier as us being professionals as well.
Yeah, thank you so much. I actually truly like what you guys said, that they want to prevent going back to 2008 to have the market collapse. So these measures are actually going to keep people in their homes. And I think that's a really, really good thing for them to have it in place. Okay, so how long do you have to have a full-time job to qualify for a loan to buy a house? Do you have to be in your job for 1 year, 2 years? Like, how long of an employment do you need to qualify for a
All
job?
right, we can
That's a loaded.
It's
You
getting
got
ready to
that,
get
Gary.
interesting now. I feel like we can ready to start soliciting some business.
Yeah.
No.
Oh, man.
Well, I'm talking about
So
consumers.
they are different because of different programs. I think there are different requirements. I think FHA, you definitely need to have 2 years. Conventional, you can get away with less than 2 years.
So let's use a story or an example. I've seen borrowers able to get financing if they were in college and they did, let's say, 4 years of college and they got an engineering degree, and then all of a sudden in their first month they're working at an engineering firm in Washington D.C. and they're full-time employed. Do they have 2 years of work history? No, but the previous couple of years they were in a trade school, and that equates over to work experience. Does that kind of make sense?
Yeah.
Oh, yeah,
That's a
do
good
that.
example. I've seen a high school student be in a trade school for what was Mr. Johnson? I can't remember exactly the trade. Plumbing school, doing his apprenticeship, came out, full-time job, 40 hours a week. He was able to get financing. So I think that's why I said it's a loaded question a little bit, because there's so many different ways that each of us, because we are very creative, that there's different products and things of that nature that are available. But I don't want to say it's a gray area, but you have to have a 2 years of work experience. That's what we have to put on our mortgage application. However, there are a lot of different caveats and ways to be creative with that.
It's the key word that Aaron used was experience. Okay. Because I personally had a scenario. I closed a lady right down the street over here in Mays Quarter, where she was a officer in the military. Okay. And what she did is she was a trainer, and she got denied by multiple other lenders because she became a school teacher that school year. And they were like, you don't have 2 years history of teaching, so we can't do your loan. And so what we did was we just asked her questions and went a little bit deeper and said, what did you do in the military? Oh, I was an instructor, this, that, and the other, blah, 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 blah. Oh, so you were an instructor, so you basically were teaching, blah, blah, yada, yada, yada. Yes, okay. So we got a letter of explanation from her commanding officer when she was in the military outlining her job requirement. Line that up with the fact that she really was teaching. She's a school educator, obviously teaching kids, and you documented your 2 years history of teaching. She closed with it took us a little bit longer because we had to connect the dots, but she only had like a month and a half on the job, gave us a full 30-day pay stub, and it was closed. Yeah. So the key thing is that is not necessarily how long on that particular job, it's how many years in your industry. And you can make changes to that. You can be working as, a chemist or a chemical engineer, say, you know what, I'm tired of this, I'm gonna go sell cars. Obviously nothing related, right? Yep. I'm gonna go sell cars. You know what, I'm a horrible salesman, I'm gonna go back to engineering. And you can basically do a letter of explanation outlining that. I was an engineer for, 5 years. I got tired of it, thought I wanted to sell cars. It was a lifelong dream, took it, realized it was commission. I was horrible at it. So I needed to make sure my bills were paid. I went back and got, working, a similar job doing the same thing as, before. Letter of explanation is explain all that transition. Most banks would more than likely approve that because you have the history. Now, if you change industries altogether and there's no connection between what you're doing, it's 2 years. You'd have to wait.
So Gary, I love stories. So I had a refi. No, I don't because the thing. Listen, this is a great
stories
platform.
Are great.
No, but it's a great platform.
Officers are enjoying talking to each other.
No, but I think it's good for consumers because when you hear stories, people can actually. And I know with me, I can connect to things like, oh wow. Yep. So I had a refi in January, and if you've been in the business 15 years, you've had this happen. Refi in January, guy's a government contractor, doesn't tell you that he quits his job. Didn't tell you. All of a sudden thought he was going to get another job and nobody found out about it. He quits his job, takes a higher paying position, but it's a 1099. So now he's self-employed. He comes to me and says, is this going to be a problem? I said, yeah, you went from getting a W-2 to being self-employed. He said, how do I get my loan? I said, you have to find another job, literally, or go back to being a salary position. A month later, I don't know how, this guy, he defends stuff, gets his job, we close his refi, but he realized, he was like, wow, he said, I'm thinking that I went to put better myself. And I've said, yeah, but from a lending standpoint, you went from no risk to all risk. And banks, that's how we look at it. So the reason why we tell stories is that it's very, very relatable. And each one of us and everybody out there that's a consumer can relate to say, okay, how does my story fit into my lending? Am I cookie cutter? Am I going to need somebody to help me structure this? And that's where we all have talents, because when we can get creative, that's how we get deals done.
So, Mr. Gupta, I want you to jump in and talk about the self-employment programs then.
Well, because of all this stuff happened, so usually what happens is we have full documentation where you get FHA, conventional, good rates and everything, but there are borrowers who don't show that much taxes on their tax returns. There are borrowers who are not showing higher income, so we cannot go as a full document. So then what you do is you have programs, they are called non-QM programs. Out of the box programs, before all this stuff, there was less down payment, but there are still investors who are doing it. Like you get a 12 months bank statement. They go into the cash flow program. They look into it, what is your cash flow is, then depending on what your expenses are according to the industry, they would call you. The factor is that, of course, there's a high risk programs, there's the rate of interest is high. They want you to put more down payment, but that's the only way to get the house for those.
So there is still hopes for people who are self-employed. They can still purchase a house, except that the conditions are a bit tighter, right?
Previously, they used to have like 10%. Now they want more. They want 25%. They want a little higher rate of higher credits. So it is there, but very limited investors who are doing it, who can take that risk.
Okay.
So, but those are the programs where completely people don't have it's all cash flow based. They're like asset based. There's a different out of the box programs are still there, but have to be aware that you have to put a lot of down payment. People who have TIN numbers, they do have a program for that. They want to put 20-25%.
So my understanding is, and you guys can clarify, for self-employment people, it's difficult or it's not as easy to do their loans because a lot of them are business owners and they report less income to the government. Let's say someone made $100,000. They probably wrote off $80,000 in expenses accrued in their business, and then they are reporting on their taxes that their net income is $20,000. We all know the loopholes in the tax system allow them to do that. But for lending purposes, when you guys are looking at their taxes, you are like, oh no, I can't lend money to you because your income is just $20,000. That's how I believe it works. Can you guys kind of highlight that?
Yeah, I wouldn't say we can't lend them money. We just can't lend them what they're looking. In that scenario, I just can't lend you $500,000.
Exactly.
I can definitely give you a $40,000 loan. I can do that all day with my eyes closed.
But that's not
now, whether Anita is going to find you a 4-bedroom for $40,000.
203K.
They would
now here's the easiest way I explain it. Anita, you and I have had this conversation so many times, and then I'm sure you end up at my new friend down there in the bottom left corner, Mr. Gupta. But at the end of the day, the easiest way, it's a little bit of an oversimplification, but here's how it works. When you're self-employed, if you tell the government, hey man, I didn't make any money. I can't pay you. I didn't make anything. Well, you can't then come over to me in Woodbridge and be like, yo, Gary, look at all this money I made. I want to go buy this $500,000 house. What you have to do in those cases is if you want to work with me, you're going to have to, claim that income, pay your taxes on it like you're supposed to, and then you can qualify for your normal standard programs. It's not difficult to qualify. It's just like you said, most people who are self-employed just don't either A, have the wherewithal, have the self-discipline, or just have made a conscious decision. I'm not going to pay taxes on this income. Instead, I'm going to exploit, the loopholes and the things that are available to me to minimize my income so that I can minimize my tax burden. And that's where fantastic programs like Mr. Gupta's talking about, and you sound like you have a really good handle, a lot of experience with those, where you go there and they do those programs based on, 12 to 24 months bank statements and, profit and loss statements, things like that. Because, at the end of the day, all three of us know you make the money, but we also, all three of us know you didn't pay taxes on it. And all three of us know Fannie Mae and FHA and VA are only going to give you credit for ultimately, again, oversimplification, but they're only going to give you credit for what you paid taxes on. So that's where a lot of those specialty programs that Mr. Gupta's talking about come in very handy, but then again, it comes at a price. So
yeah, it comes with a good price, that's why I try to avoid those things, because you don't like those things. Yeah, because a customer is never happy with those programs.
No.
But what I'm hearing, it looks like there is program out there for everyone, regardless of what kind of job you have,
Oh my gosh, yes.
Definitely.
Yeah.
I would agree with that 100%.
It's like the more you stay away from the documents, the more risk factor they have, then they want more money, they want more higher rate of interest.
Yep.
Ultimately boils down to, at some point, you do have to pay the taxes because you are not able to pay 8% versus you have 4% taxes, If you would rather pay the taxes, go into the full documentation, do it.
I never thought
You're
about
paying
it like
it anywhere,
And guess what? You're not paying the federal government taxes. He said you ain't paying the federal government taxes, but you're going to pay the interest rate.
Pay the interest rate, exactly.
Which they come out to be the same.
Yeah. So bottom line is, there are programs, but yeah.
So stated documents, I think, of the past, or Mr. Gupta's program kind of fill in the gap for stated income programs.
Most of the investors are going away, but there are few who still doing
stated incomes. Okay.
Whoever, I think they probably still have the secondary market for that, but ultimately, I doubt it. If this thing goes up like that, they will go away as well.
Okay. So let's talk about part-time income. How is it determined, or in terms of loan eligibility? How is it counted? Part-time income.
Your average.
Yeah.
Unless you have declining income, unless it's declining, if it declines more than 25% year over year or year to date, zero. But otherwise, it's a 2-year average. No gaps.
A lot of times I get into this, that person has started working one job for 2 years and then they just started another job, and the borrowers is thinking, oh, now I have 2 jobs, so I make more money. I can afford the house. But when it is a 2 job, you need to have a 2-year history of the second job as well. Then only you can qualify for the full income. So I get a lot of questions regarding that.
Okay. So any of you offer foreign investor programs? Do you have programs that for foreign investors can come in and purchase any loans?
We have a foreign national program. I'm not sure because I can only speak for myself. A lot of our non-QM stuff has gone away or been suspended temporarily. I know we did have a foreign national program to where you're talking 25% down.
Yep.
Not sure how favorable the terms were, but that was the one. We had a foreign national program. We did have that. I'm not sure if it's still available though. But Mr. Gupta, he might still have it.
I think still there's 30 to 40% now.
Yeah.
I Please, I have not done it, since last so many months, but guidelines are keep on changing for those ones.
Yep, daily.
Must be because some investors who are still doing it, but it has gone to 30-40% down.
Okay. So I hear the new thing I'm hearing on the block is drive-by appraisal. Is that a thing now?
What is that again?
Drive-by appraisal.
Yeah.
What's going on with that?
Most of the appraisals, that's what I'm doing it. They are all drive-by appraisals.
So
We do not want
appraisals
to
are
go
no
inside.
longer going into the homes?
Most of them.
I wouldn't be so bold as to say that.
I can't. Mr. Gupta can say that. I cannot say that. Okay, I cannot say that. I can tell you that my team and my assistant and I, we'll run a loan through LPDU, and we're rolling dice, hoping to get an appraisal waiver.
Right.
That's what we're doing. But no, we're still. I mean, it's just a change because of COVID. Everything has changed. So you've had some guideline and investor restrictions, but I know for us,
Purchase loans, they
still
are doing
doing
a drive-by appraisals.
but it's also based on investors as well. What Gary went back to earlier, it's
Yep.
what the investors will accept.
Yep.
Some investors are on our end are saying we under any guidelines where it has to be interior inspections and things of that nature. Now, consumers and listing agents, everybody's taking proper inspections, but I just think that it's based on the investors. I think Gary wants to say something about that as well.
No, I mean, I think it's pretty straightforward. I think a lot of people are just trying to exploit the fact that, hey, now I don't have to have the appraiser come in my house. True story. I have a loan officer here that tried to make a case that the seller wouldn't allow anybody in the house because, and they wanted to do a drive-by appraisal on FHA. Well, the problem with FHA is that house, more or less has to be move-in ready, right? Well, this particular FHA house was in the middle of a renovation and the floors was all ripped up and they had drywall off. Well, of course they wanted to do a drive-by because they knew it wasn't going to pass. So drive-by appraisal for convenience, no. Those, at least on my end, are all being held by or being taken care of by our appraisal management company, where they're actually having conversations with the appraiser. And if there's truly extenuating circumstances, probably to the fact where somebody has been diagnosed with the virus and they're sitting in that house on home quarantine, yes, probably they'll do a drive-by on that. But as far as regular business, I'm doing normal standard appraisals. And to be honest with you, that kind of stuff, to me, it's a black and white issue. If you're well enough and have all your wherewithal to move a property and you want to buy a house, you want to sell a house, you can let somebody in your house for 20, 30 minutes to take some photos, take some measurements, do an assessment, and move on. So.
Okay.
And I think, and another thing, Gary, and I think we'll all agree with this, the consumers are worried. The appraisers don't want to be there anymore. So these guys they're taking their precautions. They want to stay healthy. They're doing everything they have to do to protect themselves as well. So as much as they have to do their jobs properly as well, because remember, every appraisal, they're getting monitored. They're getting graded on these. So this is something that they're looking out for their profession as well.
So 450T forms. I hear that consumers now have to go out and get it from the IRS or something like that. What's going on?
4506?
Yeah, 4506D transcript.
No, 4506, you get a IRS transcript.
Yeah, I what I heard right now is because of COVID, you guys are lenders are very slow in obtaining that document. That is in consumers have to do it. I mean, somebody told me that. I don't know how true that is.
I've had an issue because our processing center closed. So I haven't been getting transcripts at all.
Okay.
Yeah, I think, Gary, we've been highly suggesting. I mean, a lot of the customers have been having luck going on irs.gov and pulling their own tax transcripts. So that's what we've been recommending to clients that if you can pull them, get them yourself, because all of our operations teams and our back end, it's insane in getting them with the amount of volume. And now that we have this pipeline full of loans that we're trying to pull through, if clients can get those themselves, it'd be very, very helpful.
Okay.
Yeah, it can be done both ways. Either we get it or the borrower can get it as well.
Okay. Last question. The difference between refinance and home equity line of credit. Can you educate consumers in that?
Before that, I want to tell that on a 2019, some of the borrowers who are getting, who has to be approved with the 2019 tax return income, and they have not filed their taxes, there are some regulations from the investors that can be done. Qualified couple of clients like that, and they have to have 2019 self-employed income. That's how you do that. You know. There are some regulations, so when they need it, that can be done.
Okay.
Because even though the IRS has done it like until July or so, you can file your taxes. Some of those, they really need 2019. There are certain guidelines to follow and still can be done.
Okay. Okay. Thank you for that.
Sorry.
So refinance and home equity line of credit, what are the differences between them?
Refinance is you are lowering the rate or whatever the benefit is. So that usually what happens is, as people have asked whether they want to do a cash out or they want to do a credit line. So cash out, refinance cash out versus credit taking an equity line. So right now equity line rates are very, very low. So you have to figure out, there are certain guidelines for the credit line. You need to make sure whether the client qualify for that, or they want to just go with because the rates are also low. So they just go with the 30-year fixed, refinance, cash out. They are away with that. So they don't have to pay the 2 mortgages. The credit line is like your money. You pay it, you still have that credit line open. So it all depends on a criteria, whether you want to get the credit line or you want to do a cash out.
Okay. You guys have anything you want to add?
Yeah,
Okay.
I think that's a pretty good summary of the refinance, kind of the difference. I think it's perfect.
Okay.
You always have access to that cash. Now I was gonna say the one thing Mr. Gupta said, you all with the credit line, if you take out $50,000 home equity line of credit and you pay it down $10,000, you still have access to that extra cash. To whereas if you did a cash out refinance, that's a one-time payout, and then the next time you have access to it is once you pay down that loan. So the home equity line of credit is a huge tool for, and also can be used for, a lot of people don't realize that, is you can use a home equity line of credit to actually go use that cash to purchase another property, purchase another financial asset. That's a huge opportunity. So if you have access to that cash and you're thinking about maybe purchasing another property, but you weren't sure where you could actually get that down payment from, that's a huge tool for you as well.
Okay.
The important part usually I face is when people are going to buy another property, then getting a credit line on an investment property is very hard. So rather than using that, what if they have a good equity in the property and they want to maybe rent it out, departing residence? So previously, before that, they should get a credit line on the primary.
Got it.
Like Aaron is saying, that you can use that as a down payment, but at least have a credit line open, which you can utilize it any other time. After you did it, and then you have to do it, then the mostly option is investment cash out. Then it is hard to get a credit. So that's a very good point you raised. Good to have a credit line. I always tell everybody, first thing, if you have it, and the credit line goes up to 100%. There are banks, if you have a good credit, good income, they will lend you up to 100. Then why not? Don't use it. At least keep a credit line open. Anything happens to your job, anything happens, please, that safety net is there. Then suppose what I tell a lot of my borrowers is, you have a credit line of $30,000. You have 20,000 lying in your saving account. You are getting hardly anything. Whereas in a credit line, if you take that money out, you put it back, that money back in there, you are only charged for the balance of that amount. So rather than keeping it separately, utilize that. So in the credit line, you can play with the money. That's what I call it. Rather than equity line is nothing, that money is not doing anything to you. Like right now, rates are 2.753%. You can use that money for something else rather than just having a good thing than, oh yeah, I have $100,000 in my house. Nothing. It's not doing anything for you.
Absolutely.
Yeah, so that could be a good safety net if you're in a good financial position. Good safety net for everything going on right now. Take out a home equity line. That way, if something does happen, you have it sitting and ready, because who knows how long this is going to last.
Absolutely.
Exactly.
And what happened to our friend Anita?
I was gonna say,
She said, okay, you guys are talking too much. You guys talk.
I think we're still on Facebook Live. I see it up on the top that we're recording.
Yeah,
on
it's
Facebook.
there. Yeah, it's playing. So I was just, I was like,
That's
man,
good. I was
where's our
always
gracious
used to be
host?
nervous about the VHDA loan. Now, so VHDA, they don't do the second underwriting,
Plus. Oh, no, sorry. Yeah, VHDA
Yeah.
doesn't do, I don't think the last few I had done, they didn't do their own. No, I take it back. Yeah, if you're not delegated, then yes, they do have to sign off on the package once you
Yes.
clear it. But once you do 10 and they all go through clean, then you can become delegated, which means you just underwrite them and close them.
And close.
Yeah. So,
All right. So
anything else anybody wants to share that might be relevant?
No, I was gonna say, I guess we can share our contact information because I know she recorded this, so she's probably gonna post it.
Okay.
If anybody wants to reach me, you can reach our team at www.aaronsimmonsteam.com,
okay.
or you can just Google me. I know it's for all of us. Google Aaron Simmons. I can't hide from anybody, guys. I think as loan officers, we realize that, man. Your phone number, but yeah, aaronsimmonsteam.com. And if anybody has any lending questions, I'll let Mr. Gupta and Mr. Miller give out their information as well.
All right. Gary Miller, American Financial Network up here in Woodbridge. We're on Facebook as well as Instagram. So you're more than welcome to search me on there. Gary Miller, American Financial Network. Same thing, AFN on Instagram. Just do a quick search, follow. Email gmiller@afncorp.com. Phone number 703-688-2711.
I'm Atul Gupta. Website is dmvhomefunding.com. My email address is gupta@dmvhomefunding.com. And I'm here in Chantilly. Right now I have license for Virginia and Maryland. You can reach to me at 703-608-908. Thank you.
Yeah, that you guys got me with my phone number. 703-728-2812, and I'm licensed in Maryland, DC, Virginia, and North Carolina as well. So if anybody has any lending needs outside the DMV area, I can help you as well. And I think this was a great summit. Glad to talk to some other professionals. Always learn something. I mean, that's the thing about doing these. Always learn something. For any consumers out there, reach out to us. We can definitely help you. But this was a great opportunity, and I hope you guys stay safe. Take care of yourselves. Take care of your families. Have a great one.
All right. Y'all do the same.
Thank you.
Thank you, guys.
Okay, guys. Thank you.